So thanks for joining us today. Welcome to the July edition of Market Matters. Just by way of reference, this is going to be a quarterly review. So the uh, agenda for today might be a little bit different than prior periods. But basically, we're going to run through a quick economic update, a review of price performance and index performance during Q2, and then use some of that information to inform how we're looking at the outlook for the remainder of the year, but also out into potentially 2022 and beyond. I would say also, typically we would have our founder, Hank McClarty, on the call just to provide some comments about what's going on with Gratus at the quarterly outlook, but he had a scheduling conflict today that came up last minute, so we're going to have him on next month in August, and then every quarterly review after that for a few minutes at the beginning. So let's get started. Turning to the economic update, I think this is a slide that maybe seems familiar in a lot of ways. It's a big drawdown in 2020, followed by a big updraft in 21. And then this would apply to a number of different indexes that we follow. This one actually happens to be the Architectural Billings Index, a little bit of an obscure index. So many of you probably don't know about this index. Basically, any move above 50 would indicate there is increasing demand for architectural services. Any move below the 50 would indicate a contraction in demand for architectural services. I think, one reason why I like this indicator, it's one of the many that we use as part of our composite to really frame out the economic mosaic. But, I think what's good about this one in particular is that real estate tends to be a very a dependable index or industry where capital commitments are not made very casually, because they tend to be very long duration assets because they're being built for 20 plus years at a time, and an increase in these indexes would indicate that participants, particularly in both commercial and residential real estate, see strong demand at least for the asset category in the future. So this is a positive, of course. I would say one of the negatives, or maybe it's a neutral, not necessarily a negative, but does have important consequences to consider. And that is the employment picture. As I mentioned last time in June, but I would reiterate it here in July. This is a picture from the Bureau of Labor and Statistics of two readings. One is the unemployment rate that's seasonally adjusted, and one is a picture of the non-farm payroll employment. So let me just take the left side first. So you can see the rate of unemployment coming into 2019 and into early 2020 was hovering right around 3.8%. And it got all the way up as high as 15% in the depths of COVID. But I think more recently, what's happening is that it's leveled off at this 6% level, up from 3.8 pre-COVID. And that has important implications, because it may suggest that the structural level of unemployment in the US needs to be higher as an assumption, meaning that in the future, fewer jobs would be necessarily needed to keep the economy going, which I think would not be inconsistent with a number of other countries. Europe, of course, comes to mind, as that's a hospitality, but also manufacturing driven economy with finance in there as well too. But certainly technology, I think, is playing a big role here, and its deflationary forces are helping, I think, keep a lid on more jobs being taken up, and then also the unemployment rate being higher. And in actual numbers, what this chart shows you here on the right is number of millions of people employed in total in the U.S., not that don't live on farms. You can see there's a rising trend. From about 150 million up to 153 million, went all the way down to 130 million, and now we've kind of decelerated a bit around this 146 level or so. But still, the difference between 153, 146 is about 6 million jobs, and that's not an insignificant amount. That is, in our mind, creating some deflationary pressures, which actually might be part of the reason why the bond market hasn't had a big sell-off yet. And what's causing people to not seek, employment, or why is the structural level of unemployment higher maybe than previous periods? Well, the common answer is, well, it's all of the entitlement payments that are being given is acting as a deterrent to getting people out to work. And I think there's definitely something to that. And this is a survey. By no means is it scientific, but I think it does help inform where people are coming from to some degree. And what it shows you is roughly 10% of the respondents did say that unemployment benefits played a role in them not looking for jobs with any sort of urgency. The bigger fears, of course, were COVID. This is back in May and June. So it's a recent survey. Was the dominant reason why people didn't go back to work into an office setting, at least, or looking for work. But also things like spouse had it employed. So maybe considering quality of life pre-COVID and post-COVID, I think is an interesting consideration to keep in mind. There's also this indication that people had some financial savings or means to rely on to take their time within the job search function. And then also, I think it's a big one that's maybe impacted a lot of us, which is care responsibilities for younger children. Now, some of these should go away or mitigate as we move into the year, particularly a new school year. I know in my house with 3 young kids, we're all very eager to get back to school. So, that's certainly going to go away. But certainly things like COVID fears may remain in some parts of the population. Spousal unemployed, that's not going to change likely for a lot of folks. And then, financial cushion there may be some additional capital people can move back on. So I think, if anything, getting back to that number I showed you on the prior page of a 3.8% unemployment rate in the future is likely a very low probability. So we just need to think about what that means longer term, not only from an investing standpoint, but productivity standpoint in the US. So let's take a look at Q2. And here we're just going to run through some charts of the major indexes over the quarterly period, just to give a frame of reference for everybody. And then in the outlook, we'll move into a longer term view. So during Q2, this is a picture of global stock markets. The gray line or black line here is the S&P. It was up roughly 8.3% for the quarter. International markets, developed markets, those are Europe, Australia, Japan, Singapore, were up 5.4. US small cap stocks, interestingly, were only up 4%. And the emerging market stocks were up 4% roughly. So, some big divergences in US versus basically everything else that coalesced around the same return profile. One of the big things that did happen, as you'll see in a moment, is towards the end of the quarter, the US dollar index actually strengthened pretty significantly in the last few days of the quarter. I think that actually had more to do with this outperformance over this short time period than anything else, because this is about the time when the US dollar started to really strengthen. Looking at fixed income markets, a very different picture from Q1, because in Q1, it was fairly negative across the board by and large for most asset categories. But you can see here, emerging market bonds were the best performing, up 4.3%. Again, a very different picture year to date, because Q1 was pretty bad for EM bonds. Investment grade bonds rallied back 4% during the quarter. Junk bonds were up 2.1%, and the high quality bond index, which is the Barclays Capital Aggregate Bond Index, was up 1.8%. And really, the only main driver here, as I would tell most clients, was this is a kind of a reversion back lower in yields that really spiked up in Q1. So from here, obviously, we've got a lot of decisions to make regarding the bond market in particular, and we'll go over some of the way we're thinking about bonds right now. But generally speaking, a very positive environment for bond investors during Q2 as well. And then finally, some other indexes we don't typically touch on, but I think it's important to note. Things like commodities in Q2 were up 16%, because I know there's a lot of inflation concerns out there, particularly among clients and us as well, because inflation does have a way of muting equity returns by way of pushing the price to earnings multiple down. But really, one of the bigger surprises for the year so far has been the complete turnaround or outperformance of real estate. US real estate REITs were up another 11% for the quarter, which follows on the heels of a positive quarter in Q1 as well. During Q2, the dollar index was down 1%. You can see there was a pretty massive change here, as I was referring to, where it was up roughly 3% during the month of June. And that had a constraining or muting impact on international assets, which came in through the end of the quarter. But it's also important to consider too, like, why is the dollar rising or falling? Why is that important to keep an eye on? Because I typically don't like to spend a lot of time on currencies because they can be a little tricky to figure out sometimes. Actually, they are tricky to figure out. But one of the main reasons is when the US dollar index is rising, that because most global trade is still denominated in dollars, that has a capital constraining impact on all of our trading partners, because things that we're exporting or goods and services that are being transacted in dollars become more expensive to international buyers. So globally, it's a problem if the dollar is rising, particularly if it's rising quickly. But if it's within ranges that are tolerable, 1% here and there over a quarter, that's not a big deal. We also want to make sure we're keeping an eye on that as well too, because if the dollar were to sell off pretty dramatically, that would also mean that inflation would likely be a byproduct shortly thereafter. And so we want to keep an eye on that. So that's how most major indexes shaped up. So let's get to the meat of the presentation, which is our investment outlook for the second half and beyond. And I always like to start off with our investment ratings. So hope you all find these valuable. It's really meant to just share with you any changes that we have in our viewpoint, meaning, in the prior quarter, what was the investment committee's thinking on certain categories versus where they are now. And note that we've only made one real shift, which was upgrading the liquid alternative strategies into a more attractive viewpoint versus a neutral positioning. That I think is a natural byproduct of interest rates that are migrating potentially a little bit lower from here. So we want to make sure that we're able to maintain income in portfolios in a way that's not necessarily tied to either the stock or the bond market. So one way to do that is through liquid alternative strategies, as you all know. We still have a no exposure or zero exposure to junk bonds, no exposure to emerging market debt. That's in the case of junk bonds, that hasn't necessarily worked in our favor because that's been the one asset category that's in fixed income that's positive for the year. But in emerging markets, it's certainly worked in our favor because that's the asset category year to date that is down, I think, the most of all fixed income categories. And really, we consider these bond categories really more alternative type bond approaches because they do pull in a lot of equity exposure. Like when the equity market's down, these assets tend to sell off as well too, which is different from the muni bond market, investment grade bond market, and the government bond market. Still have similar ratings across the board for both international and US stocks. You can see in a moment here where we're putting some additional capital to work. Generally speaking, I think there's a few items to touch on here which are noteworthy. One is we should now, I think, expect some higher volatility from here because, number one, it looks like we're going to get all the price earnings multiple expansion that we're going to get for a little bit of time, or at least until interest rates decide to make a big move one way or the other. So, interest rate fluctuations are driving many asset category returns right now, but it's sporadic. But that shouldn't necessarily be something we fear because volatility can be our friend in a lot of ways, particularly for those of us that are a bit more patient. We are again nearing a rebalance point on as part of our portfolio management process. So 4,400 on the S&P. I know these are nice round numbers, but that's actually the exact number that is one standard deviation from the previous point that we rebalanced our accounts later in 2020. So we'll be looking for that to start that process off. And then we are increasing portfolio liquidity because as risks start to rise, which maybe they are in some cases in some asset categories, we'll be rising cash levels along with that to be ready for any opportunities that come about. On the equity side, we continue to maintain positions that we've had for a while. And I think that's been the right answer more recently because we've held on to our large cap growth positions after trimming them back earlier in the year, held on to them, not making any substantive changes of any sort. But those really rallied back very hard in the last 3 weeks of June, which have brought in most of our equity strategies to a above benchmark positioning is in terms of performance for 2021, which is we're really excited about. And I would mention too here related to equities or stocks, elevated valuations in stocks. I think they make some sense though, despite the S&P trading at a 21 times PE. They do make sense, as I'll show you here in a moment, in the context of very strong earnings that have been coming through, and a matter of fact, earnings upgrades. Active strategies continue to be one of the only ways we want to gain exposure to equity markets outside of a few index positions that we like to hold on to. Market internals, as I'll show you here in a moment, have historically provided nice early warning signals for trouble ahead, and currently those signals are not flashing at all. So we're going to make sure we keep an eye on those. But for the time being, it looks like markets should continue to march higher with earnings going up. Fixed income, we're definitely keeping our fixed income strategy higher in quality, shorter in duration, which means interest rate exposure to the index, but we don't want to go too short. And I think that's a common trap a lot of people fall into, is that they go very short in their bond duration, but don't recognize any of the positives when interest rates go down, if in fact the economy decides to roll over. So we're shorter than the index, but enough duration to have it meaningful to performance. I think inflation is still a big question mark, as I'll show you here in a moment. But as I mentioned earlier too, the structural unemployment is a big hurdle that needs to be overcome for inflation, in my mind, to go a lot higher from here. And we are definitely not chasing yields the Fed wants us to. In a lot of cases, we're trading at all-time low yields in high yield bonds and preferred stock. And that is just a horribly unattractive proposition for us right now. It's just not worth the risk. A 4% yield on a high yield bond, or 4.5% yield on a preferred stock that can go down 20 to 30% as they did last year or more, is just not attractive. And then alternatives continue to remain a core part of our portfolio process, where low levels of volatility currently in both the stock and the bond market present good opportunities to add to those positions that can benefit when volatility comes back, and also adding income generation to that mix. So here's a year-to-date picture of the main equity markets that we've been tracking starting from January 1. And you can see small cap continues to lead the markets higher, which I think is a very positive sign. And as I mentioned earlier, this big move in the S&P 500, this black line, was really driven on the back of strong earnings coming out of a few sectors, energy being one of them, but also technology had a very strong showing in the latter part of June. So we're very pleased with that outcome. In large US and international companies continue to remain our core allocations in stocks. But again, as I mentioned, we are looking at active strategies in the mid cap and even small cap ranges that could have a place in the event that some of our large cap growth in particular becomes overvalued. So here's what I was talking about as far as not being terribly concerned that the market went up 16% or so year to date, because particularly in Q2, all of the increase, or majority, 90+% of the increase in the S&P came because earnings estimates during Q2 for the second quarter rose almost the exact same amount as the S&P did. So zero multiple expansion, which is very good, because S&P rose 8.3 during Q2. Earnings in the S&P were revised upward over the course of Q2 by 7.5%, which means that there was very little to no multiple expansion, and that this move higher just makes sense, I think. So back half of 2021 continues to look very strong from an earnings perspective, and that, in our mind, is going to be what drives stocks higher. Now, the internals, this is a view of market internals, and just bear with me for a moment here, but internals can mean a lot of different things. A lot of people associate it with technicals, market technicals, and I'm not a big fan of market technicals necessarily, but there are a few indicators within, I think, the market internals that are bearing mention or worth looking into. One is this S&P 500 advanced decline line. And this is a great indicator. It's not, by no means is it foolproof or 100%. You have to combine this with other things. But generally speaking, so the black line is the advanced decline line with the index here on the right side. And this is the S&P 500. It's back since 98 with the index on the right side in red. And so the advanced decline line is just constructed by saying every day, how many advancers are there versus decliners? If there are more advancers than decliners, then the line moves up for that day. If there are more decliners than advancers in aggregate of the 500 companies, then the line moves down, and it can move, rapidly up or rapidly down based on numbers. So what it does is it's one way to, I guess my point here is periods of market weakness are precipitated by fewer and fewer stocks advancing. And that is, basically the construct of the advanced decline line here. And this is something that we monitor on a weekly basis that's available in that weekly chart pack addendum that I send as part of now the 2 Minutes with Todd webcast or podcast every Monday, if it's not a holiday. So let me just show you what this looks like in real time. So this is the first part of the chart. This is the 98 to 2002 timeframe. I've just blown it up here. Hope you don't mind my graphics here. Same charts, same line, same chart, just one's blown up and versus the other. So the black line, you'll notice back in 98, this is October of 98, went up. Then it kind of flatlined through the middle of 99 and then started going down, meaning that fewer stocks were advancing versus declining. Actually, more were declining versus advancing. And this is a classic contrarian signal because, as you can see, the S&P kept motoring higher by a lot of those tech stocks that were large cap in nature at the time. It was Qualcomm, Emulex, JDS Uniphase, Cisco, and a few others that were bellwethers of the day. But when fewer stocks are going up, that just means that the breadth, as they call it, starts to deteriorate. And what happens is that as this line starts going down, you had about a 12-month advance warning that something was not right within the equity markets. And it's not just in 1998, 99, as you're seeing here, but you also got some of that advance warning back in 2007 to 2009 period. So you can see here, I've same index, same S&P chart, with the black line here really peaking out in the middle of 2007. And then it failed to make a higher high at every point after July of 2007. So you had a lower high, even though it popped back up in September, but then it really started to deteriorate, commensurate with basically a deterioration in the market. But this is a sustained deterioration over like a 6 to 9 month period. And this is important because this deterioration didn't stop, and it usually trends one way or other for quite some time. And you can see here that this gave you, I'd call it roughly a 9-month advance warning that a bigger potential decline was ahead. So, if the advanced decline line wasn't moving higher over this period, over a 6 to 9 month period after going down, then that, I think, signals that trouble was on the horizon pretty clearly. Now, where are we today? This is where I say some of the market internals are giving us, no real cause for concern quite yet, because as you can see, the black line continues to move higher, which means there's broad participation in the S&P 500. And where is that participation coming from? It's coming from things like chemical stocks, energy stocks, healthcare, materials, and not just technology. Technology is working as well too. And so this is a very, I think, positive setup because you have a very large component of the S&P that's moving the markets higher. And so, currently we don't necessarily see a lot of issues with where we are. Now, obviously we can get a 6 to 10% garden variety drawdown, for any reason at all, or, a COVID-induced, 20 or 30% drawdown, but, no one could see the COVID-induced drawdown coming, and nor is the advanced decline line going to tell you that either. But I would say for more economic activity related drawdowns, then this is a pretty good indicator. I've also heard from some clients that, they've been reading some of these stories in Barron's right now, so I thought I would just address it here about how the S&P has been up now for 5 quarters in a row. This is only the second time, I think, in the last 100 years that that's happened. And shouldn't that give us some concern? Shouldn't that be scary to want to commit new money into? And I would say not necessarily, because remember, I think in my mind at least, the COVID drawdown of a peak to trough of about 30% really almost resets the recession clock for potentially another 5 to 7 years from last year, because you really had a clearing out effect of a lot of different bubbles in the economy. Things like small cap got absolutely decimated during the drawdown last year. Venture capital got really nailed. Cryptocurrency, biotech, all the hot sectors got really beat up. So that provides a nice floor around which to make markets move higher. The last time this index, the S&P, had 5 quarters in a row of positive performance was in the mid 1950s. And you can see very nicely here where we are currently in the S&P, charted at the exact same time that it occurred in the 50s. And what was the experience after that 5th quarter occurred, when for the next like 3 or 4 quarters. And you can see very clearly here in the 50s, the S&P went up another 26%. So not to say that's going to happen, obviously, that you can't be specific with these things, but there is some support to say that we have further gains in our future because there's quite a bit of momentum at our back by way of either fiscal stimulus, which is yet to happen with the infrastructure package here in the US. You also have other different stimulus packages moving around the globe in other parts of the world, which is very positive. And I think all that's going to combine to sustain this elevated growth profile in the aggregate economy for a little bit more time. So I guess what I'm saying is, to net it out, don't necessarily fear the fact that the market's been up as much as it has in 21, because there could be some more gas left in the tank. This is a picture of international stocks. This is the all country world ex-US index. And I just wanted to point this out as, again, this is not necessarily a technical indicator or any sort of readout here, but you can very clearly see that it does look like international stocks are now breaking out up to the upside, which is usually a good thing because we're now getting broad participation. And I think this is also instructive or informative as to how we think about international stocks, because it's been quite some time that international stocks have outperformed US stocks. And so when we start to see these types of breakouts definitively to the upside, that could lead to some positioning shifts, which, as you all may be aware, we upgraded last year our international positions to 30% of a stock portfolio versus 15% in 2019 and 0 in 2018. So now we're at probably our target weight for international, but this gives us a lot of confidence, this breakout here, that we're getting broad participation and that the rally may have further to go, particularly in international markets. Zooming into emerging markets, that is a subset of international markets. We have a very small position here, and I think that's sized appropriately for the type of risk you can get with emerging markets. But my point in showing you this here is that it does appear emerging markets are also having this similar experience with breaking out from a, call it a trading range that was pretty well defined for the last 12 years. And now it's moving above that range into a higher level. So this, I think, bodes well for future gains in select emerging market stocks. I wouldn't say we are a big fan of emerging market indexes right now, particularly with what's going on in China, but selective exposure to emerging markets through active strategies is our preferred way to get exposure here. Looking at fixed income briefly, you can see here what I was talking about, junk bonds being the only index or asset category to post a positive return for the year at about 3.1%. And every other fixed income category is basically coalesced around this negative 1.2% for the year, which is really strange, given the three indexes have really arrived at almost the exact same return for the year. Our fixed income portfolio, either it's muni or taxable, has done significantly better than the index, which is this black line here. In some cases, for those that have shorter term individual bonds, those performances are positive for the year. But for our mutual fund strategy that's in fixed income, the average portfolio is probably down, less than 50 basis points or something. So kind of right up in here. And there's, I guess the point I make with that is that active strategies can add a lot of value to the index. Even though it's slightly negative, they're preserving capital, not losing much when the markets are down substantially. And I think that's exactly what they've delivered on so far. And I think this is an important thought experiment to come into, because last Market Matters, I was talking about how I was a little concerned that stocks and bonds were correlating. So if this line goes up, this is a picture of the S&P 500 as its correlation to the long treasury bond. And when it, typically over most of its life, certainly back to 2003, bonds have had a negative correlation, which I think has been the historical pattern, at least for the better part of the last 30, 40 years, which means, if stocks are going up, then bond prices are going down and yields are going up. So it's that seesaw with bonds. In this case, if stocks are going up, that means yields are going up and prices down, but that actually flipped the exact opposite direction, meaning prices down and yields are going up. So a return to a more normal correlation, to a negative correlation, would be, I think, appropriate, because we want to make sure we're preserving diversification within our portfolios. It does appear that this correlation has some sort of mean reversion to it, so I wouldn't be surprised to see this correlation come back down negative, which would mean that if stocks continue to go up, that yields would likely potentially start to fall again. So we'll be keeping an eye on that for sure. And then I know there's been a number of questions from clients around commodity prices, and isn't that going to cause inflation, or isn't that going to be problematic, or is this something we should be looking at investing in? And there's a few points I just wanted to make here before I wrap up, which is commodities are notoriously difficult to handicap from a price attribution standpoint, because commodities tend to be controlled by a small handful of companies or countries, OPEC being the prime example there. And where when small groups of people control commodity prices, they tend to, not necessarily act totally rational sometimes. In the case of, Russia or Saudi Arabia, that's definitely the case, because they have other budgetary concerns they have to worry about. But one of the things that I wanted to point out here is that commodities are very volatile, which means you can have good price movement to the upside. You can also have very poor price movement to the downside. And I think this is a big question mark, is, can commodities continue to climb without tanking the economy? I think right now, because many participants, including the Fed, are saying that inflation is going to be, quote unquote, transitory, I mean, it's going to come and go, that commodity prices aren't necessarily going to be too impactful to longer term inflation, because at some point supply and demand will balance out. The prices will come down. You can see it's already occurred in lumber. It's happening in things like gold this year and other commodities. And of course, there are some that are doing quite well. Actually, the best commodity that we follow is this little obscure index right here, which actually there just became an ETF available for. It's up 70% for the year. It's the European Carbon Credits Index. It's an investable index, believe it or not. And I think that's actually one interesting takeaway for me, is that carbon credits are likely the future, or in the future of the US and many other developed countries. And if carbon is going to be more expensive via like a cap and trade policy or something like that, then carbon credits should continue to go up. And this is, I think, one big byproduct of the ESG movement, because as you may have noticed in the news, companies like ExxonMobil, Chevron, and others are not necessarily committing a whole lot of new money to new discovery of oil to get it out of the ground. They're basically sitting on their reserves right now. And that in and of itself is going to make gas more expensive, but it's also going to make longer term things like carbon credit, or carbon in general, more expensive to pollute, I guess. The picture of lumber is fascinating, because a lot of people like to point to this as, inflation is on the horizon. And I think this just shows you where some of the issues are and how quickly things can fall back. Price of lumber is actually really very close to where it started the year now. This is a couple of days after the end of the quarter. So it's up a little bit. But it's down 50% or so from its high. And really, we have to understand what caused the price of lumber to go up so much versus what might be the consensus thinking around it. Well, really, after COVID occurred, a lot of lumber mills shut down, number one, because workers didn't want to show up if they were going to be exposed to COVID. So you had a critical cog in the wheel of lumber manufacturing shutting down, which put a lot of pressure on those mills that were existing and existing supply. And that shot prices up because, as you may be aware, as I've been mentioning, housing, single-family home building, and single-family homes in general are very in demand right now. And the key input to single-family home construction is lumber, because most houses are frame lumber on a concrete foundation. So you had a substantial uptick in demand for lumber combined with a substantial contraction in supply of lumber, and that's causing this. Now, what happened here, a number of the lumber mills, after vaccines came out and people started feeling more comfortable, came back online. So I wouldn't be surprised if this index fell further, because prices in homes are not necessarily inelastic, which means that there's only so much people can pay sometimes for a single family home. But commodities will always find their equilibrium. It just sometimes it takes faster than others. So just a few key takeaways to sum up the comments from today. And I would just say, as I'm going through these, if you do have any questions, feel free to lob those into the chat feature of Zoom, and I'll try to grab those off and address those once I've run through some of these comments, or I can catch up with you after the call here. So a few key takeaways. Some of these might look familiar, some might look a little different, but we still continue to favor stocks over bonds. We've had that bias of a slight overweight for most clients since really the start of Q4 and into the first part of this year. So, just to summarize here, we did put out some capital market forecasts, which should inform where we would be committing capital longer term. And with the outlook for traditional bonds, the price potential for bonds so low, we thought that a higher allocation could be supported, particularly with some of the dynamics of earnings we saw coming through the system. We still continue to favor as well alternative strategies where we can do that over bonds. So private markets in particular have very nice income generating features to them that are substantially higher than publicly traded bonds. And these strategies have been working as they're designed, meaning that they're not pulling in a whole lot of equity market beta or interest rate sensitivity. And so we think it's a very nice diversifier, but also can really help improve the outlook for a financial plan. And also with volatility so low, these are strategies that really benefit when volatility returns, which looks like that may be upon us for the summertime. I would also say, because volatility is low now, be prepared for some higher vol later in the year. We don't know exactly what's going to cause that, of course, but with the VIX volatility index right around current levels, it's around 15 or so. That's come all the way down from an 80 reading in March of last year, and as high as 20 or 25 in Q1 of this year. But so be prepared for some volatility. A 5% to 10% correction would be totally normal after such a strong move up during the summer months. And that would be an opportunity for us, assuming that the earnings picture was similar, to deploy capital into typically stocks or other higher volatility assets that might be temporarily depressed in price. And just as a final reminder here, we are continuing incrementally, not wholesale, but we are continuing to raise some cash, again, via ultra short-term bond funds, to really prepare for that rainy day that could be on the horizon. We don't know exactly if it will or not. This is just part of our risk management process that I think worked exceptionally well last year in the first part of this year. So, we are fine with being patient for the time being until opportunities show up. Hopefully I've helped illuminate what we're up to in the portfolios, kind of the approach and the outlook for what we see in the horizon, which continues to look pretty good, driven by a very supportive macro environment. And I think that's about all I had for today. So I do want to thank you for your time today. I really appreciate you spending the time with us today, and look forward to talking to you again next quarter.